Welcome to Premium Cashflow Real Estate Investing Podcast with SK059. During this program, you will hear guest experts sharing their experiences, best practices, and market insights. We discuss investing in multifamily apartment complexes and how a busy professional can passively invest hassle-free in various opportunities. Your host, SK059, owns millions of dollars of assets and has done thousands of value-add projects over 20 years now. So listen in for insights. Here's your host, SK059.
Welcome to another edition of Premium Cashflow Podcast. Today I have the pleasure of speaking with Andrew Greer. Andrew Greer is with Thomas Strafford Investments. Welcome to the show, Andrew. I appreciate your time today.
Hey, thanks for having me on today.
Awesome. So Andrew has been doing, for real estate developments and has done multifamily flips as well for many years. Today we will, dig into his story and understand the intricacies of real estate developments. His market is California, from LA through San Diego. So it is a pretty expensive market, and quite a lot of details in general specific to their, their niche. So with that, Andrew, welcome to the show. Give us some background as to, how you got started and how you came about into real estate development space.
Yeah. So I started just about a decade ago. And I came from being a stockbroker and then wanted to get into investing with hard assets. So I started out doing flips, buying flips, working with investors on debt and going that route. And then about 6 years ago, just over 6 years ago, I bought a flip that had the opportunity to build a home next door.
Interesting.
And when we went through the process, figuring out what we could build, it turned out that we didn't have enough space to build a home because the survey was done incorrectly previously. So we ended up reaching back out to the seller. They own the lot behind it, which was much larger. And we negotiated a deal to buy all of the land. And from there, did our first real major joint venture and did a subdivision.
I see.
So we built multiple houses. In the end on that one, I ended up building out the map, getting it entitled and selling it. And then we went in and started doing more subdivisions, more single family homes at once. And then about 3 years ago, we really pivoted more towards multifamily.
Interesting.
Yeah.
Lot to unpack into that story, Andrew. So thank you for sharing the detailed background there. You said, Andrew, that you started with a lot of multifamily and single family flips and things like that. Give us a sense of what price points we are talking about, and those flips took how many sort of months to finish up, and then kind of how you transitioned into the sort of the real estate development, or sort of the rezoning and best use of land and things like that.
Yeah, so our flips, we really had two types that we did. One not being truly a flip, it was called a custom remodel, and I'll explain the difference. But most of our flips range from about $300,000 to about $650,000 on acquisition. We'd go in, it would take us between 30 to 60 days to complete the flip. Ideally faster. I mean, we had one where we were in, out, and sold in less than 47 days. So from time we purchased to time we sold. So it was very fast.
Sure.
But that was our main objective, was those quick ones. And then we started going after what we called the custom remodel. So we'd acquire a property. One example was we bought one in a very nice coastal community for $497,000. We went through the process of adding 1,100 square feet to the home itself.
Wow.
And then sold it a year and 1 day later for $1.45 million.
Wow.
So it was there's a very large spread in that one. We spent about $375,000 on the actual project, but in the end, it turned out to be a really good project, and we started doing more of those long-term hold projects And that really opened the door where we got a lot more comfortable with construction and going after acquiring larger deals to build out multifamily.
I see. And you stated, Andrew, you added 1,100 square feet. Was that like maybe adding, refinishing basement or adding a bump out? How did that come about?
Yeah, so we added a second floor
Okay.
to the property, and we
Mhm.
added a garage.
Mhm.
And then we added a really cool feature. It was a staircase that was all glass around it. So
Sure.
when you pulled up to the house, there's this big glass staircase with lighting. So it just made it so it really tied nicely into the house as an
Sure.
architectural effect. But
Awesome.
yeah,
Awesome.
that's how we added it.
I see. So like a spiral staircase with a glass perimeter all around.
Yeah, it was really
Awesome.
cool.
Awesome. Awesome. Good, good. So, was that sort of the pivoting moment, Andrew, in your story where you said, hey, you know what, these, candidate projects that perhaps have a lot of upside, but perhaps come with a decent construction element to them. Is that was kind of the genesis where you said, hey, you know what, these type of deals make sense. And that's how you shifted towards real estate development of sorts?
Yeah. So what happened is we realized there was only so much growth in flips. There was also only so much we could do with in-house equity. But as we built out our processes and systems, we could plug in the appropriate contractors and vendors to do a majority of the day-to-day work.
Mhm.
And we could start focusing on acquiring larger deals and then managing them, being the general partner of them
Mhm.
through the process. So our real need at that point was additional capital
Sure.
and
Mhm.
creating those opportunities.
Mhm.
And we quickly learned that bigger deals really are, it's more larger numbers than it is more work in many situations. Now that,
Sure.
yeah,
Sure.
it's not that you're to do a quadplex or to do a 26 unit project ground up.
Mhm.
Really, on our end, it's just a little bit more time and a lot more money, but
Right.
it's
Right.
not a whole lot more work.
Right,
Um,
right.
when
No,
you're
and
doing,
an interesting thing in this, Andrew, is also we are talking about San Diego and LA type of markets. So the real estate in general is so expensive. And when you try to reposition or renovate these things, I mean, considering the permits, the bureaucracy that comes along with it, I'm sure the ultimate project cost is a whole lot more than, like some other submarkets, which are, a lot more inexpensive that you would kind of compare to, right? Give us a sense, Andrew, as to what sort of is a good candidate project for perhaps doing a redevelopment. Like what sort of opportunities, for example, today you look for?
yeah, so we're heavily focused on rezoning. So
Hmm.
if they've come in and they've rezoned the property, the land,
Hmm.
we're looking to buy old single family homes or maybe a duplex
Hmm.
that's in disrepair where we can go from 1 unit to, let's say, 10 units.
Sure.
So right now I have one that's in construction. It was one 900 square foot single family home.
Hmm.
We're currently on the second floor and it's 10 units with tuck under parking underneath it, and it's just far more density. But when we go in to buy it as a single family home in distress, we can be
Hmm.
very competitive and actually purchase it at the right price.
I
Um,
see. I see.
Another one, oh, go for it. Sorry.
No, I was just going to ask you. I mean, I've been part of the similar projects wherein I think you're tearing it down, having a sort of a covered parking on the ground floor, and all your residential units are all above. Is that kind of the model you're describing, Andrew?
For the most part, yes, we try and get 2 units on the ground floor so we
Hmm.
can meet our ADA
Sure.
standards without
Hmm.
having to do an elevator.
Right.
So we try and go as efficient as possible to reduce elevators, additional amenities, depending upon where the project is.
Hmm.
We're generally B minus C plus neighborhoods, so we're not doing pools. We're not doing a lot of amenities. It's blue collar,
Sure.
entry level rent.
I see. I see. And when you're doing these, Andrew, are you maybe starting out focusing on, hey, like some of the census tracts where perhaps that the zoning of the land itself enables you to perhaps do these type of high density type of projects? Is that kind of what the game plan is, more or less?
Yeah, we're very targeted in San Diego
Hmm.
on three main factors. We want our zoning to be one dwelling unit per 1,500 square feet. We
Hmm.
want to have the transit priority bonus, which means that it goes to one unit per every 750, and it
Hmm.
adjusts our parking standards. And then we also focus on qualified opportunity zone. So
Sure.
we have the tax benefit. It reaches our target investor much better,
Hmm.
and it reaches a lot of our goals. In general, our emphasis is to keep as much property as possible. We're
Sure.
not trying to flip it from dirt and then sell. We
Hmm.
do, but that's not our overall goal. Our overreaching goal is long-term hold.
I see. I see. Thank you for that detail. And also, Andrew, we will definitely discuss more about opportunity zones, the details, and the different nuances within it. But I want to kind of ask you by saying that these projects that you're doing, right? Like buying a single family home, right? Then let's say tearing it down, starting a complete new construction and adding, let's say additional units and things like that, right? Give us a sense of what sort of price points we are talking about. Like, let's say you buy it at X number, then you are raising it, and then pretty much re-permitting it for adding the additional units and things like that. Give us a sense of like what sort of numbers are we talking about here?
Yeah, so I'll give you an example. So in a part of town, closer to downtown, up and coming neighborhood, we paid for a project $390,000, 7,000 square foot lot with single family home.
Mhm.
We put 125,000 into design permitting, the first level of plan check permitting, not all the permitting,
Mhm.
and then getting it to the next level.
Mhm.
After that, there's about another 275,000 on that project
Mhm.
and some miscellaneous holding cost, as well as our development impact fees. That's where we pay for police, fire, libraries, parks with the
Sure.
city.
Mhm.
And
Mhm.
for the permit, the construction on that building was about 1,050,000, 1,075,000, right in there. It's a
Mhm.
building that we're doing multiple times.
Mhm.
So it fits on a set lot. So we're starting to really narrow down how to make it work, so we
Mhm.
can reduce those costs.
Sure.
So, so all in, that building will be in it for right around 195,
Sure.
uh, and
Mhm.
then it'll be worth about 275 when it's done at a
Mhm.
475 cap.
I see. I see. And it's fair to say that based on some of the numbers you stated, that the uh, all the development impact fee, your permitting and design fees and things like that are more or less 30 to 35% of what your construction cost is. Does that sound about right?
Yeah, it comes out there.
Mhm.
With some of our projects, it can get higher based on neighborhood. So I
Sure.
have one just up the street. The development impact fee is 180% of this neighborhood
Wow.
because of the parks and services and amenities nearby.
Mhm.
I will get dramatically higher rent too,
Mhm.
just because of the location. But it's about 13,600, and the other one was 7,200, 7,300 per
Sure.
unit.
Mhm. Mhm.
So yeah, it varies, but yeah, it's safe to say right around 30 to 35%, maybe as high as 40 to 45.
Sure. And in your example, Andrew, where you said about 7,000 or 7,300 square feet lot that you had, uh, how many units you added during the redevelopment on that one?
Uh, it became from 1 unit to 10.
Oh, wow. Okay. And what's the
Yeah,
average sort of square foot of one unit?
these are micro units, so they come out at 525 square feet on average.
I see. And Is that mostly rental grade type, meaning
Yeah,
like renters?
all rental grade.
All renter get okay. And who's sort of the candidate renter there? Like, are they students or young professionals? What sort of tenant profile are we talking about?
Our biggest tenant is going to be military, so
Oh, interesting.
it's very close to the base. So it's actually within a mile and a half of the base.
I see.
So using their benefit for housing, they can rent this place and still have excess. Like we're not tapping out their full amount in
The housing allowance, basically.
Yeah.
Interesting. Very interesting. And if you don't mind me asking, the 500 square feet, what sort of rent are you getting on this ones?
About $14.95.
Wow. So let's say 1,500. So
yeah,
let's say 1,500.
San Diego is a very different market.
Sure. No, absolutely. And that's why I highlighted earlier that the markets we are talking about are totally different, but you still have to use sort of the numbers and the common sense as to why we are doing what we are doing. And it's incredible. So you go for lack of a better term, if we sort of understand the investment thesis here is that you are more or less investing $2 million to get a brand new 10 unit or 11 unit. And I guess if we were to see the cash flow as well, your gross rents are trying to think 1,500 times 10. So wow. So 15 to 18,000 depending on, so that's like your monthly rent, gross rent.
Yeah,
right?
We're actually a little bit higher. So a couple of things. We have 1 2-bedroom that gets about $1,750.
Okay.
And then we actually charge for storage and for parking. So we charge $50 for storage and we charge $75 for parking.
I see.
We also manage the internet in the building. Sure. So we offer it at a discount, but we make $25 a door off of that as well.
Wow.
So we have these ancillary incomes that we make as well off of the property.
Absolutely.
And then with the transit priority, that is how we're able to actually do that. We're allowed to separate those out. So I could rent every parking spot in my building to one person if I really wanted to.
Sure.
So it creates a different dynamic, and it's very beneficial.
Sure. Absolutely. And what about the utilities, like the water, sewer, and all those charges? Do these get prorated and passed on to tenants as well?
We set them all up individually metered. So we sub-meter the water on site, and then everybody has separate meters for electrical.
Interesting.
And then we aren't running gas on any of these buildings.
So these are all electric stoves and all that. I see. Wow. Awesome. And now let's talk about, Andrew, the sort of the time component in this, that, you're purchasing it, every step of the way you have permits and all the bureaucracy, the inspections and all that. So basically you're dealing with a lot of, sort of the holding cost as well. Give us a sense of like how you're sort of managing all those details.
Yeah. So one of our biggest strategies on holding cost is we have a model called Cashflow Entitlement. We usually buy something that has rentable units on it or is very close to rentable. We'll actually go in, flip, rehab it, because our permitting process can take 18 months to 24 months. And a lot of times we Airbnb them. So we turn them into Airbnbs and we generate income off of them. Prior to COVID, in the month of July, I had 3 units going on I had 3 duplexes next to each other. 3 of them are long-term, 3 of them are short-term. And the 3 short-terms could generate $24,000 in just 1 month because of Comic-Con, 4th of July, and then Pride, which just drives a ton of traffic to San Diego. Sure. The rest of the summer, we would generate between 17 to 20,000. And then in off season, we could get 12,000 to 13,000. So turns into a considerable amount of income, and we really focus on buying that way. And there's really 2 components in it: 1, the rents, and then 2, for the bureaucracy and permitting and getting through the process, buying property with an existing building on it and tearing it down actually has less pitfalls than buying raw land because of a lot of the environmental consequences and different stormwater consequences here in San Diego.
Sure. And I imagine that you probably don't have that much vacant land or lots available as such, right?
We don't. There's not a ton available. Sometimes we've acquired stuff where somebody had bought double lots in the past and
Sure.
maybe had one as a large garden or a large backyard. We've bought those in the past. But we actually avoid it quite a bit because I bought one for myself personally, and it's taken me 4 years to get my permit. So
I see.
Yeah, so we try and avoid them.
I see. Now, Andrew, in your model, it seems that you buy it outright. You are basically while you are renting out and you're during your permit phase and things like that, you are definitely getting some cash flow, right? And then pretty much as you start to demolish the building and start your construction, that's when everything goes poof, and that's when you're pretty much holding costs and things like that kind of kick in. So are you doing like a bank financing, like a construction loan on these, Andrew, or give us a sense of some financing side of these projects?
Yeah, we work with some banks, small regional banks. And then we work with some non-QM lenders as well that get us very competitive rates. But the majority of it, to explain kind of the genesis of a deal, if this will make a little bit more sense, me and my partner and maybe a sponsor or one other person will go in and actually buy the property prior to even raising the money.
Sure.
So we'll go out, we might buy 3 or 4 properties next to each other to assemble. We'll go through a process where we invest a considerable amount of our money, sometimes $100,000 to $300,000 in permitting, design, consulting, get the property to a certain point of approval, then we'll raise for the syndication. So we come through with a certain level of clearance, like this is what we're doing. This is what we have approved. One, it gives us upside in the value going into the syndication, what we get. Sure. And then 2, it allows us a certain level of security for the investors, depending upon what they want, knowing that this is approved, that's approved, or we have this hurdle to jump. Sure. So we'll raise at that point, generally within 6 months, maybe a year of when construction is going to start. So that money we're raising in the syndication is oftentimes going towards that holding cost. So that way we can prep for that and be ready. But that's really the majority. But yeah, as soon as we start construction, and some of these projects can take up to 18 to 24 months to build, depending upon the size. Sure. We have to be ready with the cash in the bank to make sure we can get to the finish line.
I see. Now, Andrew, one of the sort of the problems or one of the most contentious elements in all of the development process, as we know, is a couple of things. Basically, every time I hear the word, it's the community hearing meetings. Like the community hearings can be extremely challenging. The feedback process, the input from the area residents is always negative. They are complaining about either the traffic or the parking issues and things like that, right? And then I guess, of course, is sort of the endless loop of permits and, sort of the design refinements that we have to do and things like that. Give us a sense of some of your experiences that, what sort of, problems you had, how you kind of overcame them within some of these things.
Yeah, so we've had our battles. So we had a 40-unit complex that we were trying to design, and we had 165 or 167 people come and speak out against it.
Wow.
And we had that one not approved. I had a coastal development that I was doing where a gentleman threatened to beat me up in the parking lot for not providing 3 parking spaces per unit, only providing 2. I've been through a lot of those community meetings where really what it is we try and follow what's allowed to the T. So we just go take the abuse and then it gets approved. So we try and do what the city council wants us to do. And then additionally, now our primary and main focus is only doing what's called by right development. So it's we design exactly within what's required for that neighborhood, and there's no community hearing. So
I see.
It supersedes that. We're not asking for anything unusual. We're not doing a development of a size that can cause any contention. We're just trying to build them by right. So I just go straight to construction docs and I don't actually deal with any of that process.
I see. So it sounds like this is a local sort of a community, not community, I should say, the local municipality thing that that you have to be extremely sort of knowledgeable about and carefully study what's allowed, what's not allowed before you can purchase the deal. Does that sound about right?
100%. That's really one of our specialties in San Diego is we know two cities very well, city of San Diego and the city of National City. So my favorite thing is when people present me a deal and they're like, hey, I got this deal. You can do this, this, and this here. I'm like, no.
I know better than you.
You might think you can, but it's not going to get through. Like, if we want to buy it, it's going to be an 8-plex, not a 12-plex. So that's how we have to buy. And, I don't go down the path of the community fights anymore just because it's far too time consuming.
Sure.
And it's just not the smartest way to go.
Sure. I can totally relate. I mean, I've been through a bunch of those myself on different projects, and the amount of time, energy that it saps it's quite incredible. Now, Andrew, give us a sense of you buy these buildings, right? And you're having all these things, right? Like different tenants and all that, right? Is your strategy more into buy and hold, or are you more about let's buy them, let's syndicate them, and at some future point, like 3 to 5 years, sell them? Give us a sense of how's your exit strategy around these.
Our main strategy is 10-year holds minimum because of the qualified opportunity zone element.
Sure.
So that ties us in where we're looking at it from the point of view of we want to get the full tax benefit, have no federal taxes on our gain after 10 years. So that's our main goal. Do we build to sell? Yes, we do. And we will. Primarily right now, we build to sell to get capital gains to put into qualified opportunity zone. We do it, but it kind of ties into the other strategy.
Sure. For viewers of ours who may not have heard of all the different benefits that come with the qualified opportunity zones, give us some tidbits about what they are, how they came about, and what are some of sort of the top 5-7 things, the benefits of them, please.
Yeah, so came through in the Jobs and Tax Act of 2017, designated just over 8,700 census districts as qualified opportunity zones, meaning that if you invest and double the actual building assessment on the property by 100%, you can maintain tax deferral until you turn in your 2026 tax returns. You also get a 10% jump in basis, which means that you had $100,000 in capital gains. You're now paying taxes on $90,000 instead. And then after 10 years of holding that property, you are federal tax free. So all profits, all gain is tax free. So it becomes really great for individuals looking to shelter their income. The next thing, and this is one that we've seen a lot of success with, is if you have a 1031 and you want to just sell and take the gain out, not move over all your equity at the same time, and you can find a qualified opportunity zone investment, you can actually just take that gain out and not move all that money at once, and then go through this process, defer 10%, and then pay no taxes on the gain after 10 years, where 1031, you're just kicking the can down the road until you get to the point that you actually pay it. So
Sure. Mm-hmm.
it could be very valuable in that way. They're generally in areas that are suffering economically in 2010. That was when they did the census that set the districts.
Sure.
In San Diego, there's neighborhoods where they are definitely not in economic pain, just like Los Angeles and Arizona, some of the markets I've looked at where you can get some great stuff and do these deals and help influence. We like doing, C plus, B minus neighborhoods a lot. And there's huge areas that are like that you can do the development on. But it's really development heavy, buying a building that's existing. If you buy a large building, if you have to invest 100% of that improvement value into that building, it's going to be difficult. So it's really designed to be ground up new construction projects.
Sure. And you also said, Andrew, there that you are also syndicating some of these projects, right? So give us a sense of, just the details of the numbers, or perhaps what is the investor appetite for these projects, like for investors to come on board and invest within your projects?
Yeah, so we've done a few of them right now. So we have 3. The investment range has ranged from 2.2 million for one to $1 million for the others. And really our main investor probably is coming in, if you averaged it out, it's probably about 125,000 is the average investment. Some people going much higher, and others coming in at the $50,000 range. But our focus really is like 250,000 is our goal. That's where we like to play. It makes less investors, less LPs, easier to manage. Obviously, we would all like to have one LP and just get it done. But that's really where it is. And you have to diagnose with the investors prior to even sitting down that they're interested in long-term growth. They have to be interested in long-term, because we're taking it and we're saying, hey, this money's not coming back for at least 10 years.
Sure.
Not that it's coming back in 10 years, it's at least 10 years. Because we don't want to just sell in 10 years. We want to, plan around where the market is, where we are in a cycle to actually disposition.
Sure. And of course, you are tying in with sort of the guidelines within the Opportunity Zones Act there, and that's the base business plan. And they say around 2026, as you said, if the time is not right, perhaps the hold period can get extended, right?
Yeah, yeah, because you have to sell by 2046. So
that's a long time.
You just have to get past 10 years and then not go past 2046.
I see. Now, Andrew, some sort of a central question, right? Like the model where you buy, you tear it down, renovate, and, go through a heavy construction period and things like that, right? What are your thoughts on this model versus, like a typical multifamily value add buildings that you can buy, perhaps even in opportunity zones for that matter, and do value add and do the traditional, sort of the syndication that we see? Give us a sense of, what is your philosophy about pros and cons, and why you like the development game versus, some other plain and vanilla multifamily syndications that we typically see?
Yeah, for us, it really comes down to what we're good at and what we can get paid for as general partners and create good returns.
Sure.
In San Diego, finding a building, and I like to shop locally. That's just kind of how I am. So I could go to other states and start looking at other projects, but really to shop locally, there's no value add apartments that make any sense in San Diego.
Sure. Right.
You're not going to finish your construction and have the, let's say 25% equity at that point. And that's what we really want. We want to be able to get money back out. We want to be sitting there with little to no cash in and have the equity in there to keep it running, and then just sit on it and let it cash flow for us.
Sure,
So and that's just harder to do on the value add side. Now, if things change, would we go out and start doing that? 100%. We're not going to say no to a deal like that. Mm-hmm. We just aren't seeing them.
Right. I mean, it's an expensive market. I mean, just like, let's say, New York City, or like, closer to New Jersey, New York border, those areas require, sort of different strategies. And definitely, as you point out, redevelopment and rezoning the houses and reconstructing them and adding more units, it's definitely a viable strategy, and it's a perfect instrument for doing syndications, in my opinion. And as I shared with you before we got started, is I have, come across a lot more investors in your market as well, doing something similar, projects, or doing the retail flips. So there's definitely sort of, methods to doing different real estate strategies based on, what the geographic area or the submarket is, right? So yeah. Good. Thank you, Andrew. So give us some sense, Andrew, as to, what sort of different, projects that you are looking at right now. How do you see the market reacting to COVID and things like that right now?
Yeah, I mean, we like one of our buildings that we're building, and we want to do it over again. It's a 10-plex, and it works really well. It fits into our standardized lot, so we want to keep looking for those. I do think that COVID has actually heated up the market in San Diego. It's been unusual. I think it'll slow down, but my focus is multifamily. And right now, according to the data from the census and then from the city of San Diego against permits and how we do our regional analysis, we're 57,000 units undersupplied.
Wow.
So the ability to build and add more units and get them rented up isn't going away. We have a major supply problem, which is a great equation to be on the demand side with.
Sure.
So I don't see that affecting us right away. Maybe we get some issues where people are moving in, and one reason why we sub-meter all our buildings and have everyone pay all their utilities is a lot of times in recessions, people move in, you get a higher tenant count per room. Sure. Now, if you're paying utilities, you're going to see that number go up, but your rents not go up.
Absolutely.
So this is something that we like and why we focus. It costs a lot of money to actually sub-meter everything, but that's just the way we do it. Like there's
sure. Absolutely.
So that's for us. We're going to keep going for these high density developments in the urban areas that are having the infill right now, and just really focus on that. And I mean, we got word that we have 6,000 more sailors coming to San Diego. So we need even more units, and we're just going to keep going out.
Good. Awesome. Thank you for sharing all the details, Andrew. It's been a pleasure. Please share with your listeners, how they can find you and learn more about your company and different projects you're doing.
Yeah, the easiest way is you can go to thomas-strafford.com and check us out there. And if you want to reach out to me direct, you can get me at andrew@thomas-strafford.com or Facebook, Instagram, all those places. I'm Andrew Greer. It's easy to find me. I chat on all of them. So I've actually raised capital via Instagram. I had somebody set an appointment with me to learn about a development because I had posted a photo. So,
awesome.
Yeah.
Great. Thank you, Andrew. It's been a pleasure. Viewers and listeners of our podcast can also, learn more about guests and different projects that they're doing by logging on to premiumcashflow.com. We have the podcast link, and if you are interested in any of our projects or any of our investment opportunities that may be coming on, kindly register with us using Invest With Us link. We will get onto a short phone conversation, understand what your goals and what you're looking to do. Many a times we are taking only accredited investors after signing all the proper private placement memorandum, PPM documents and things like that. So there are definitely a lot more opportunities available as well. So thank you, Andrew. Thank you for your time today. It's been a pleasure. And I look forward to, chatting with you on some more of your projects in coming future.
Sounds good. Have a great day.
Thank you so much.
Thanks for listening to Premium Cashflow Real Estate Investing Podcast. Please join us at premiumcashflow.com to sign up for weekly updates, research articles, and more. We will see you again for another great interview with an expert guest.